Fitch reported this week that the 2024 U.S. deficit is currently at 8.1% of GDP. When people say that the economy is super strong, they almost always fail to mention that we are currently running historic deficits not seen outside of World War II, the 2008 global financial crisis, or 2020 COVID crisis. If we weren't running this deficit and balancing budget, GDP would likely collapse and economic recession would already be admitted. And while the Federal Reserve is now signaling it's pivoting next month to a rate cut cycle as U.S. unemployment has been rising, we are already seeing circumstantial evidence of recession from corporate earnings conference calls that the average U.S. consumer is tapping out of funds to spend on the basics. Major U.S. retailer Dollar General CEO Todd Vasos stated this week that their core customer is very price sensitive at this time and looking for value wherever they can find. The core consumers at Dollar General, making up 60% of its customer base, come from households that earn less than $35,000 annually. Inflation has continued to negatively impact these households, with more than 60% claiming they've had to sacrifice on purchasing basic necessities due to the higher cost of those items, in addition to paying more for expenses such as rent, utilities, and healthcare. More of our customers report that they are now resorting to using credit cards for basic household needs, and approximately 30% have at least one credit card that has reached its limit, the CEO said. His comments are corroborated by ongoing data of U.S. consumer carrying a record high of $1.34 trillion in credit card debt, and while the U.S. savings rate is currently scraping at record low levels. It's no surprise that defaults on credit cards have been on the rise across the age spectrum given all this data. This week, Goldman Sachs, BASF, HSBC, and ICBC Standard Bank out of London made a Platinum and Palladium price-fixing lawsuit settlement, basically a slap on the wrist of $20 million. The price rig lawsuit occurred from the start of 2008 through nearly the end of 2014. This latest admitted precious metals price rig was during the twice-daily Platinum and Palladium fixings, with the four guilty financial institutions sharing customer data, front-running expected price moves, and placing bogus spoof orders, which enabled banks to avoid losses on short positions they maintain in futures markets. While similar price rigging data points to gold and silver prices also being consistently rigged over a similar historic time frame. This data from 2006 to 2012 in the gold market shows how the intraday gold price was consistently rigged lower during the London AM and London PM fixes on a consistent basis over those years. Now, over the last 24 years of data throughout this 21st century, this chart suggests similar price suppression programs are still active, though not as effective as perhaps they once were. Now, looking back at the palladium market during the settlement lawsuit timeline from 2008-2014, basically illustrates what eventually happens to artificially suppressed markets. Eventually, they run into physical shortages, and the spot price explodes to eventually find a much higher equilibrium or price balance. Palladium, for instance, ran from 180 an ounce low in the 2008 global financial crisis to a price spike high of 3,400 an ounce by the start of 2022. Another piece of circumstantial evidence of a potential recession underway, it was announced this week that Goldman Sachs will be cutting 1,300 employees, or 4%, from their overall staff. Stick around. On the other side of this break, we'll run through this week's most interesting news in the silver and gold markets, and why many fundamental reasons cited are having analysts publicly call for higher spot silver and gold prices through the close of 2024. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates, and be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe, because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a Monster Box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
The spot silver and gold markets traded down on the week. The spot silver price closed off hard to close today's trading, finishing just below 29 an ounce bid. The spot gold price managed to record its highest monthly price close, still settling above 2,500 an ounce on the week. The spot gold silver ratio ballooned back up to 86 on silver's relative price weakness to gold. Craig Himke of TF Metals reminded his Twitter followers of similar gold price tape paintings at month's end that were more successful than perhaps this week's version. For instance, at the end of October of last year, 2023, we saw gold fail to close above 2,000 an ounce at the end of that month, only to be followed by a now more than $500 an ounce rally and the price bull market breakout since. This despite 25 gold market analysts calling for an average gold price this year in 2024 of just over $2,250 an ounce. Gold has been performing well this far in the year, typically up over 20% in every fiat currency you can name. And while today's bounce in relative fiat US dollar strength may have helped deter spot prices to close the week, the coming Fiat Federal Reserve rate cut cycle has analysts believing there's more upside to come. Have a listen.
What do you think it means for gold moving forward?
Well, it's bullish. So what that does is it lowers the opportunity cost of holding a no-yield asset like gold, and so people are getting into it. And it's had a great run. It's up 20+% year to date. It's one of the outperforming commodities that we cover at Panmure. So it's an interesting shift.
Okay, so where to from here? If it's bullish, could we see maybe testing 2.6, 2.7, 2.8 even?
Pick a number. It's gone nuts at the moment. Based on rates alone, I think we'll probably just see the price stabilise. And it's based on just how gold performs in rate cut cycles. So if you think of the last 20, 25 years, the dot-com fade in 2001, GFC in 2008, and tariff war in 2019, the price basically stabilised when the rate cut cycle began. So we're probably expecting stability in the price on that theme alone. But there's a lot of other drivers in play.
So let's go through them. The USD is also at its lowest level in 13 months. Is that also a catalyst for higher gold moving forward?
Absolutely. It's a US dollar asset, so it just makes it incrementally cheaper. So people feel comfortable buying a bit more on that basis too.
What else? What else is driving the market?
Well, the dominant driver through the cycle are changes in US rates. So the cash rate policy reporting through to bond yields and real rates. But there's been some really chunky bullish drivers that have played out, like war. So we've got lots of conflicts happening: Russia, Ukraine, Israel versus Hamas and Hezbollah, and we've got China-Taiwan confrontation. So these things we've noticed has actually pushed the price up in steps in the last 12 to 18 months. So that can't be ignored. But they're also really difficult to quantify because we're not really sure how the market perceives those risks.
With central banks continuing to buy record volumes of gold bullion reserves, and China now using more fiat yuan renminbi payments in payment settlements, phasing out the once dominant fiat US dollar payment settlements for its globally leading trading, the trend of de-dollarizing with direct payment settlements outside of the US dollar and central banks buying bullion over bonds, it's going to continue onward. Turning to the silver market, this week UBS reiterated a call for silver spot prices to climb to 36 to 38 an ounce later this year, citing further fiat US dollar weakness, the coming Federal Reserve rate cut cycle, growing industrial demand leading to further market supply deficits, and China's continued robust silver demand. And with recent import tax cuts in the Indian market chopped down from spot plus 15% to now only spot plus 6%, we're already seeing increases in gold and silver import demand in that market. India is on pace, regardless of record high gold prices locally, to see yet another year of perhaps 1,000 metric tons of gold imports. And with the potential of 2024 Indian silver import numbers to grow based on increasing solar, jewelry, and investment demands to near 7,000 metric tons of silver. And it is not just India's silver-laced solar demand that is forecasted to grow in the coming years. Bloomberg NEF reminded the world this week that the demand for silver solar-laced cells is not only rising, but it's forecasted to continue into the middle of next decade, the 2030s. So yeah, while silver's gains thus far in 2024 have been relatively strong, spot price averaging up over plus 20% on the year in virtually every fiat currency we can name, already surpassing almost all of the 25 silver market analysts' price predictions thus far in the year. The potential for further silver spot price climbing to close this year and to the next, they are fundamentally lining up in myriad ways that we've mentioned this week. So, I suppose it's buy on the price dips and position for the long haul. That will be all for this weekly SD Bullion market update, and as always to you out there, take great care of yourselves and those you love.
If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.